Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by Betashares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, Betashares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with Betashares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Tom, welcome back to the show.
Thanks, Owen. Great to be on again.
We're talking income from ETFs, very topical right now. Just talking off air. A lot of people with term deposits, savings accounts, even the people with money in offset accounts are thinking what other options are available now that interest rates have started to fall.
Yeah.
So we're going to cover all that and more. You got a few interesting ideas from the Betashares suite to bring to us. A few quick questions though. Number one, we're here at the Betashares HQ. A lot of smart people on the floors above and below us, probably studied finance, probably investing for years, if not decades, some of them. You've studied a lot. You've done that. Curious to know what might be something that you believe about investing that maybe others would be surprised, or maybe that some of them would disagree with you on.
Yeah, so and it might be a function of my entry into the market. I didn't actually study finance at uni. I always wanted to work in finance. I did economics and accounting, and then subsequently have done a lot of study. But in my mind, the investing part, the actual, we spend a lot of our time analyzing different ETFs, putting out new ETFs. But the actual decision of what ETF to choose, in my mind, might be the easiest part of the whole process. And I think the much harder part of the process is the complexities of the individual. Right. If you actually understand, if you actually understand, where am I at in my investing journey? What is my investing journey? Where am I at? What are my end goals? Yes, there's a plethora of ETFs out there, and we keep releasing ones that can get a little bit more out of it, But generally speaking, if you want ultra long-term growth in an accumulator, or if you're looking to build a diversified portfolio of around 5% income, you can probably put the pieces together fairly easily if you understand that other part. And speaking to this, my portfolio is just one ETF actually, which might also surprise some people I work with. At the moment, I just use our GHHF, our moderately geared, globally diversified ETF, because in my mind, very long-term accumulator, comfortable with that little bit of gearing in there. Very, very diversified. So, a few things that might surprise them.
Okay, so you went with the diversified one, 30 to 40% gearing. Interesting, because there's a lot of we won't go into it today, but there's a lot of geared funds in the Betashares suite. We get a lot of questions about them, to be honest, especially lately with interest rates coming down. We're just talking off air. People seem to be more interested in them than ever before. House prices are high for people that are looking to get into a leveraged asset, which is property. So interesting. Cool. I like that. So starting with the individual. My other thing here was that, you have done a fair bit of study, done so many things like that. But for the position that you hold, for like where you are in your career, I would say you're pretty ahead of the curve. And so I was curious for people that might be, in their careers or looking to switch careers or just wanting to get ahead generally. There's a lot of people that are in the Rask community that I would say are entrepreneurial or enterprising types of people. I was wondering if you might have any type of advice for people, maybe things that have worked for you to get ahead in your career. It doesn't have to be in finance. It could be in anything, little tactics or strategies that you might have adopted. Yeah,
well, firstly, I appreciate the sentiment. I'd say what worked for me early on was just saying yes to a lot of opportunities. As I mentioned, I didn't study finance. I always wanted to work in finance, but I just didn't know my in. I was working in London as an accountant, actually, and I'd moved back to Sydney. I was going to start a job hunt, and by complete happenstance came across Betashares and then someone who worked here, and then set up a meeting with them, went through the interview process, and then even once I was here, just taking on roles that I probably wasn't, or I didn't feel I was ready for, going in a bit over my head, but then you kind of learn as you go. So I think, it's saying yes to opportunities, even if you think it is beyond your scope, can be really helpful. And then luckily for me, it led me to probably my second piece of advice, which is, work in something or work for something that you truly believe in. It just makes it so much easier. Luckily I happened across Betashares, and I actually didn't know too much about the space. And now that I've been here for six years, I truly believe in what we're doing and helping a lot of Australians invest in it in a smart way, in a low cost way, in a diversified way. and it makes it so much easier to talk about and to promote, right? So yeah, say yes to a lot of opportunities, and then also try and find truly what your passion is, of what you believe in, because then it's much easier to do your job.
For sure. I love that. 2 good pieces of advice. Say yes, and expose yourself to them. But then, really just find something you're passionate about, truly passionate about. Such good advice, mate. Thank you. So we're going to spend a bit of the time now talking about ETFs for income. We're going to talk around that idea. One of the things I'd like to start with is a really simple one. It's for people listening maybe who aren't familiar. Most people know that you can invest in ETFs to get into the share market. It gives you Aussie shares, US shares, or you can mix it up, slice it, dice it, however you want, really. But people may not know that a lot of people use ETFs for income from cash accounts or from similar things like that. Like instead of putting your money in a term deposit, you might be able to look for some alternatives. Like we are big investors in a AAA ETF from Betashares as well as MMKT. Can you maybe just spend a little bit of time telling listeners and viewers why you would consider using an ETF versus putting money in a bank account?
Yeah, definitely. And there's a few parts to this answer. I mean, firstly, partly comes back to what I said at the very start in terms of what are you trying to achieve with that money? If it's the money you need for your spending requirements the next 2 to 3 months, I mean, a bank account's probably a fine place to put that. If it's for your long-term wealth creation, well, the reason why you should put it in an ETF other than the bank account is because over the long term, historically the equity market has provided significantly more returns than a bank account. So you're really hindering your wealth creation journey there. But to your point as well, even if it is the cash part of your portfolio, you want that in cash in a bank account like instrument. There are ETFs that could provide you a higher rate that you're receiving on that bank account, on that cash balance, than you get in the bank itself. Like you mentioned, we've got AAA, which gives us, we group together money from lots of different people and professionals and institutions, and we get institutional level interest rates on that ETF. MMKT takes it a step further, investing in money market securities, which aren't really accessible to you or me, to everyday investors. But again, at an institutional scale, we can get access to them and provide that to the everyday investor. So it's twofold. Number one, if that cash is for your long-term wealth creation, well, you're forgoing a lot of returns and you're hindering your future wealth creation journey. Number two, if it is just purely for your cash, there's even an ETF for that as well. So there's lots of good reasons to explore what's out there and understand how they can improve your situation. Yeah,
I like that answer. Thanks, mate. Because one of the fears that probably people have that rely on income from bank accounts, whether they be retirees or potentially they're even, younger people that do want to just make some good amount of money on their bank account or the cash. And then you got people that use offset accounts, which we can talk about separately. But people are probably fearful that we might be heading back to an environment where interest rates are 1% from a bank account, 2% from a bank account. You don't need to go back that far to remember that. Like just before COVID, for people that weren't investing at the time, but maybe weren't familiar with the interest rates either, you couldn't really make inflation come back. Everyone was talking about this thing called inflation like it never existed. So the interest rates dropped to rock bottom lows, and then COVID hit, and then inflation came like rallying back. Interest rates went up and so on. But recent interest rate cuts. So I'm curious to ask you your perspective on this. Like, do you think we're going back to that, or do you think there's something in between, or just broadly how you think about it?
I think we probably are, in a structural sense, heading back to a lower interest rate environment. Before the COVID crash and the inflation impulse we had, there were some pretty disinflationary forces in the world, technological advancements. Even since then, we've seen the developments of AI. And that has the potential to really lower costs, really lower the costs of labor inputs, the productivity of outputs. In every field, there's so many ways that AI could potentially, and technological advancements could help bring prices lower. So I think that is, structurally disinflationary. There are some counterbalancing forces. You've got things like deglobalization. You've got the trade wars and tariffs going on. Those obviously on the counterbalance. But in my mind, I think the structural forces of disinflation are stronger than the ones of inflation. And then for investors, when we think about central bank interest rates, really what are central banks trying to balance? They're trying to balance inflation and unemployment, right? So if inflation comes back down and we're back to a disinflationary world or a low inflation world, It allows central banks to lower interest rates to take pressure off the average person, to take pressure off the economy. So that's what I think structurally for the long term. Obviously, there's cyclicality to it. We can see periods of economic stress and rates will come down even lower, or there could be inflationary pulses for who knows what. No one could predict COVID and the trade war going on. So there can be cyclicality to it, but I think structurally over the long term, we are headed for a lower rate environment. Not necessarily what we saw during COVID, ultra low, but maybe, around that sub 3% mark is probably where neutral sits for central banks.
Yeah, so that's a great answer. For people that don't understand how this might impact you, hypothetically, it's if we get down to that rate, it's lower returns from interest in the bank account, but it can also have implications of, in Australia, artificially propping up property prices because mortgages become cheaper, loans become cheaper, and particularly with the recent government announcements of more basically stimulus into first home buyer markets and deposit schemes and stuff. That's pretty scary for people that are buying their first home. But so that has implications across the board. Retirees get less income. Young people deal with high asset prices from lower rates. So something that I think about a lot, as you can imagine. The question that we often get on the show, Tom, is, and I've kind of popped it in here as like a paraphrase one, but we get it in the community all the time. Why wouldn't I just put my money against my offset, like in my offset, against my mortgage, I should say? So like, for people that aren't familiar, offset account helps you to reduce interest on your mortgage. A lot of people think that that's like a good way to go about things. What is your perspective on that?
Yeah, it's an interesting one. I think it feels like going a step further than just using a bank account, right?
Yeah.
You're like, I've got this mortgage, I've got an offset account, it's a higher rate, it helps me pay off my home loan quicker. Like it's like a step further, like you're doing something further than the bank. You're like, great, I've done my investing now, I can wash my hands with it, like I'm doing better than the average punter who's not doing that, which is awesome. But again, and it really comes back to what is that money for? If that's your long-term savings, if we just look historically, yes, that's a nice pickup on the cash rate or your savings account in a bank account, but it's not going to be a pickup on what you can earn in a globally diversified portfolio, which can include some money in the offset, right? But not all of it. If you put some of that money to work in equity markets, history would show that over the long term, you're going to be much better off. And then once you've got that huge sum, if your ultimate goal is to pay off your house, then build that outside of your offset, pay it off quicker, right? So it's a really interesting one. There's a bit of psychology there as well, right? You think you're going a step further because you are, but there's still another step to take. And there's always more steps to take, right?
I do meet a lot of people that have a lot of money in offset accounts, and it's probably because they're not as confident in their investing, which, as you said, is like, that's fair enough. Like the behavioral side is really important. But I agree. The math suggests that even with the tax and different things on investing, it does work out in the long term to take that money out of an offset account and invest. I've got a really I have a friend that's a really good investor. He does it for a career, and he just puts all his money in an offset account, and he invests from time to time. He's probably listening, so I won't go too far into it, but he's much more comfortable with that because he's got kids and that sort of a thing going on in his life. So I get that, but at the same time, if you're trying to maximize your journey towards financial independence, like the traction you get, I think that's investing is the way to go. One extra thing on that. Some people push back on me and they say, well, if interest rates are high, then I should use more of the offset, which doesn't always fly because an offset doesn't reduce your repayments, it just offsets the interest. So typically when interest rates are higher, stocks are cheaper. So it's actually kind of the opposite thing that you should be doing. So just as an FYI for people who are up against that math, I've got a bit of a pop quiz for you. And you don't know what the pop quiz is. I just put pop quiz in the email. So I wanted to ask you a question, and you've probably come across this, right? So
I hope so.
Well, you could probably just using your brain box, you could probably nut this one out, I reckon. So according to IRS data, this is the Internal Revenue Service in the United States, their tax office, their ATO, right? They found that millionaires have 7 streams of income, right? So 7 streams of income, and they've been broken down here by Yahoo Finance for me, the Honourable Yahoo Finance. I'm hoping that you could try and guess what are the 7.
I have come across this,
and
I stopped at the headline. So now I wish I'd read on. Okay, so I mean, salary.
Yep.
Number 1.
Yep.
Probably some form of rental income from
Yes.
a investment property. Probably dividends from shares.
Yes.
Probably some. Does it break it? Do we have income from real estate investment trusts as well, or is that broadly captured in the?
That's captured in the
Sure.
income. Yeah.
3 so far. There could be some income from intellectual property or royalty rights.
Yes, that's a good one.
In there. Yeah.
Yes.
Cool. There's probably some obvious ones still. Probably coupons from bonds.
I'll give you that. It's interest income.
Interesting. I was going to split those out for my next.
Okay, so that's all
interest
in one.
income.
Yeah,
That's
got 2 more to go.
2 to go. Getting to the pointy end. Are they easy ones?
Nah, I reckon one of them's not actually. To be honest, I reckon one of them's probably easier if you think, what would a millionaire own?
Oh, okay, sure. Is this like what would a millionaire own? Is this like they got like Airbnb revenue from a
Similar. It's a business.
business?
So
Sure.
business income.
Makes sense.
And the
Makes
last
sense.
one, I don't think this is a real income one, but
Mm-hmm.
we'll count it in here. Maybe it's accounted differently in the US, but capital gains. So I think they treat that as a
okay.
form of income, which
Okay.
we in Australia wouldn't associate
Okay.
as income.
Yeah.
But yeah, you pretty
I
much
should have
nailed
got
it.
business income, but the rest I feel like I feel.
Oh, yeah. At least a B plus, my man. So earned income, dividend income, rental income, business profits, royalty income, which I never got when I did that. I never, because who has royalty
Who's got
income?
royalties, right?
Yeah. Capital gains and interest income.
Mm-hmm.
But isn't there a royalty ETF?
We have a global royalty ETF,
Yeah,
So
yeah.
invest in royalty businesses, which again, awesome way for non-millionaires or millionaires alike to get access to royalties, which traditionally has been the space of high net worth individuals.
Yeah. Because I'm thinking Universal Music, that
Yeah.
type of a business.
Yeah.
They have the rights to their songs and whatever.
Songs is a common thing, but where a lot of the money is made is a lot of land rights and oil rights, like Texas Pacific
Yeah.
Corporation. They own a ton of land out in Texas, and historically they've allowed people to extract oil and gas from that land, which has been very profitable for them. But now they've big tech companies want to build data centers there. Say, hey, you got this land. We want to use that for our data centers and the energy we can use as well. And so they're actually a really interesting use case at the moment for AI. And also pharmaceuticals is another one.
Of course.
You get these big royalty companies that have a lot of in-house expertise into different pharmaceuticals. They'll give early stage funding to another company who's actually producing the medicine. They'll go in, they'll use expertise to say, hey, this could work out. The other business needs funding. So they provide early stage funding. And if it works out, they can make a huge return on their initial investment. But the business itself, the royalty company, say, is very capital light, doesn't have the additional risks of going through, regulatory. They've just got the potential upside from their investments.
Yeah, just get like a monthly income.
Exactly. So it's a really interesting space.
Yeah. I don't know. This is not necessarily a great segue. I didn't know we were going to talk about that too much, but I wanted now to talk about ETFs that people could use and these types of things. But one of the things that I really wanted to talk to you about before we get into the returns and talk about the different types of ETFs is one of the things that I think about a lot, and I've written about this a bit lately, is back in my day, I feel like I'm old enough to say that now, but back before the GFC, so the 2000s, which is not that long ago in the investment world. I remember when we sold our family home when I was younger, I was kind of like math-minded at the time. Probably more than now, Tom, to be honest. I remember saying to my mum, if we sold the house, we could put the money in some term deposits. This was 2000. This was like 2007, 2008. So maybe if it was 2007, it would have been like peak good decision-making, Owen. But I remember saying to my mum, we could take the money from the house and we could get a 7.5% per annum term deposit. I was like, that is so great. And then we can compound and blah, 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 blah. I wasn't using those phrases. I was just using some rudimentary phrases at the time. But then we look back on historical returns from stock markets and things like this. Over the long term, the stock markets return like 12% in Australia for like 100 and whatever years. Then we look at bonds. Bonds were paying like really good coupons a few years ago, like 10, 20 years ago. And now we look at it and we think like the Aussie market's got a lower yield than before. Bonds are, not what they once were, but they're still good. We'll talk about that. Term deposits and bank accounts, we're lucky. Like you can get one savings account at the moment, I saw with 5%, but they're on their way down, like compared to like 10 years ago at least. So I wanted to kind of set the scene for you with that and ask, do you think that returns overall could, we should be lowering our expectations from here? Do you think I'm just curious. You don't have to have a definitive view, but just how you think about it.
Yeah, so in certain areas, Yes, probably, right? And part of that's due to gains we've seen over recent years. So if you think about the Australian property markets, an easy place to start. We think about rental income. If you think about the yield you used to be able to get on an Australian property 20, 25 years ago, when property prices were significantly lower, rents haven't appreciated the same pace as property prices. Compared to today, you're probably not going to ever get the same yields you got because of how much the property prices have appreciated, the kind of somewhat lower rental appreciation. So that's kind of capped. There's also the Australian equity market at the moment, as you mentioned, around 3.1% dividend yield looking forward is very low. At the moment, a lot of that though is again due to recent price appreciation. Like we've seen the Aussie market do really, really well. Earnings haven't kept up with it. Dividends haven't kept up with it. So for the next period, since equities are more expensive, certain equities are more expensive, then the yields will be lower. The actual cash you receive, the rental cash income from the properties, the dividend income cash that companies are paying is higher than ever. It's just the actual prices of the asset itself is also much higher. So the yield is a bit lower. But in saying that, I think, those areas of returns will be low in the future, but there are other areas that are popping up for investors to use or to look at that weren't an option 20 years ago. Like 20 years ago, you could have looked to an ETF and get internal gearing to help eke a bit more out of the equity market. And that actually, internally geared fund benefits from lower interest rates, right? There wasn't a royalties ETF 20 years ago. There's no way you could go out and get exposure to royalties. So there are areas, and people often look back and go, oh, the property market took off and, I've missed that. It really sucks. Or even, no, I didn't invest in 2021, so I missed all those gains after COVID and it's all in the past. But it's probably more important to look to the future and think, okay, well, what do I have access to now? Where can I look to try and get better returns? Because I think there will be different areas that return really well. And we could sit here in 10 years' time and ask the same question about different asset classes, right?
Yeah, you make a good point because it's the share prices of these companies have gone up, and that's what's pushed down the dividend yield, not the dividend payments, but the dividend yield. And with interest rates the way they're going, at least right now at the time of recording, it seems to be the case that some of those shares just keep going up, and the yields aren't going up fast enough, as you said. So if someone was a new buyer of shares today, it seems a little bit like the balance is not there. We'll come to some ETFs in a minute that might be able to help people deflect that. But I do think about that a lot because there's a lot of people that are on the show that might be retiring soon, changing their super fund from, accumulation to pension mode. Might be younger people looking to start out and build a portfolio, or in kind of the bulge bracket, you've got a family, but you're pursuing financial independence and dividend income becomes important. So I think about a lot of those things. And I think there's also this kind of, the optimist in me says, Tom, that the current yield might be lower and the markets will ebb and flow up and down and whatever. But if interest rates are a bit lower, that means you might get more capital growth and you just might have to adjust to paying slightly higher prices than before. So you might get, the way I'm kind of framing it in my head is like, if you assume that you get a 10% return, hypothetically, in the past you might have got like 4% in dividends and 6% in growth. Now you might get 8% in growth and 2% in dividends. Kind of like what you get in the US, like yields are a bit lower. So maybe that's where we go. And I was just really interested in hearing your perspective on that. So one more question before we get to the ETFs. And this is one that I get from the community quite a bit and just see it on social media, which is that people often criticize Aussie shares as being underwhelming. You look at our biggest companies. What we got? We've got Commonwealth Bank, CSL, BHP. You look at the US, you got Nvidia, Tesla, Microsoft, Apple, like world beaters, right? What would you say to someone who has that kind of sentiment?
Yeah, no, it's we get this all the time as well. I hear this question all the time. And look, when you list those, if you put the 5 biggest names in the US against the 5 biggest names in Australia, well, I mean, 5 biggest names in the US, anywhere in the world, you'd be underwhelmed comparing yourself to those guys. So sure, at the index level, if you just look at the largest companies, maybe it's a fair statement. But that's not the whole share market, right? We don't have to all go out and buy the ASX 200 or buy the 5 largest shares. You could buy none of those shares if you were so inclined. And when you actually look under the surface of the Australian market, there's a lot of really exciting sectors and companies. I was meant to update this stat for today's podcast. I hope it's still true, but at least 6 months ago it was that our information technology sector had outperformed the US information technology sector over the past 2 years.
Oh, wow.
It had done even better. You got obviously smaller companies compared to the US, but just as exciting and just as significant in their fields and future leaders. Companies that people would be pretty aware of from listening to your podcast or reading financial media.
Yeah.
The Wise Techs, the ResMeds, Cochlear, Zeros.
Yeah.
These are great homegrown companies.
True.
And so we don't always need to look at the headline level to find the whole market. It's probably what I'd say to those investors.
Yeah, we own the ATech ETF from you guys as well, and that is past performance, not indicative of future performance, all that sort of stuff. But recently, it's been excellent.
Oh, yeah.
Excellent. And I'm so glad that ETF exists for what it's worth, because those are the kind of companies I want to own as like someone with like a 5 or 10 year view. You're like, those are the companies that look at the US. These are the companies that are winning, and it's not, we've got some here that are smaller, right?
Yeah, exactly right. Like, I mean, NVIDIA 10 years ago, no one listened, unless you were a gamer, you didn't know that company.
Yeah, you're buying GPUs to put in your PC.
And now we can sit here and go, well, it's so obvious NVIDIA's the biggest company in the world. It's like, well, we didn't know that 10 years ago. So,
exactly. Yeah, good point. Okay, so we've alluded to it a fair bit. We want to talk about some ETFs, so some practical tools that people can use in their portfolios. So if I was to ask you to give us like 3 to 5 names or however many you've got off the top of your head, I know you've got your Betashares notebook there just out of camera, but it's closed. So Tom's going to do this off the top of his head. If we just throw some ideas out there, I'll chime in with some anecdotes, I'm sure. But where would you start? If you just want people to chuck some ideas onto their watch list.
We'll start in Australia. And the first one, I'll just give a shout out to my colleague, Cam Gleeson, who was on your show recently. Yes. He recently did a great episode with you on our new Australian ETF. HYLD, exactly right.
Yeah, so the HYLD ETF, the Betashares S&P Australian Shares High Yield ETF. It's a mouthful.
It's a bit of a name.
But it's a great ETF.
It is a great ETF. And look, we don't really need to go into it in any detail, but because you did so with Cam. So I just refer everyone to that episode. But look, another one that came to mind, and it speaks to a lot of what we've talked to so far in today's podcast about this, this fear some people might have around, there's lower dividend yields, but potentially higher capital growth to offset that, because, and it depends where each investor is in their journey, but, building that capital base initially to generate income is really important. So an ETF I propose is our Betashares Australian Quality Leaders ETF. AQLT is the ticket code for that one, AQLT. And so within that, there's kind of 2 baskets within that. We actually still hold the largest companies on the ASX. We just reweight them based on their quality score. So we hold the large caps, we just reweight. That's kind of a large cap balance of the portfolio. The rest of the portfolio is the highest quality mid caps on the Australian market. And the reason I raise this fund is it's had really strong capital returns. So it launched about just over 3 years ago now, but it's outperformed the ASX 200 by about 5%, or on average 5% per annum since then. So really strong. It's been a strong period of performance. Obviously, again, past performance, not indicated future performance. But you get a higher weight to some of these more exciting companies we're talking about. And at the same time, before I came on the show, I quickly checked on the terminal, and the expected dividend yield on the index for the next 12 months is 3.1%. So
the same as the broad market.
In line with the broader market. So not only have we got the potential there to grow our capital base potentially quicker than the market, we've got the same yield at the moment. And that's really important, because if we can grow our capital bases, even if yields are structurally lower, we're getting more from more invested, right? So I thought that could be a really interesting one for income investors to think about things a little differently. And it's still yielding higher than a lot of global equity markets would. So a great balance there.
2 things. One, I want to go back to what Cam's podcast. So when Cam and I recorded that podcast, that was the day before Commonwealth Bank came out with its latest report, and the share price sank. And Cam made the case for HYLD not holding CBA.
Yeah.
And then it sunk. And I was like, that pay credit where it's due. The second thing is, like, I just brought this up on the computer here, AQLT. Whenever there's Wes Farmers, which is the owner of Bunnings, at the top of a list of a quality ETF, I always think I like to see that because it is probably one of the highest quality companies in the country. And just for anyone that's listening or watching, you can just jump onto the Betashares website, go in and see what holdings are in there. And it gives you a sense of how the rules actually are playing out in practice. And we all know that Wes Farmers and Bunnings and all that is a great business. Macquarie's in the list too. So really good businesses.
Yeah, I'll just say when you're jumping in, particularly for AQLT, you have to be cognizant of that because you'll see the big four banks there, you'll see CBA in there. It's just that with those large caps, we still hold them, but you'll see, we upweight Macquarie, we downweight CBA.
Yeah.
And that's just to give the portfolio a large cap balance. Because if we didn't include those names, it'd be a very mid and small cap portfolio.
Yeah.
Which is great for growth, but not great for, tracking a quality factor exposure as you would expect it.
Yeah. And it gives you income as well a lot of the times.
Exactly right. And it gives that nice income. So it's been a really well-balanced portfolio, done really well, and it still has that good income you'd expect from Australian equities.
Well, a good example of this is if you go into the next lot of names from 10 to 20, you've got NetWealth, ARB, which does the bull bars, ResMed, which does the sleep apnea, Promedicus, a software healthcare company, Monadelphous, Medibank Private, which people would know, Breville, does more than just the coffee machine, even though it's like the number one thing that Australians have in their kitchen. Data3, which is like a software business, Magellan, which is a financial company, and Hub24, which is like a fintech business. So that mix of companies there's a lot of names there that would be new to people, but are super impressive, high quality businesses indeed. All right, so you've given us HYRD, AQLT. What else is on the list?
So now we'll turn globally, we'll turn international. Okay. And this again, it comes back to this thought around, how are we allocating our capital and how much income are we getting from it? So particularly even a lot of income-orientated investors, historically, when they're looking to international equities, they've kind of had to make a choice. Do I want to chase or do I want to get the large growth that the international markets offer me? Or do I try and, boost my income in all parts of my portfolio? And I'd say, you might have a better read on this, I'd say a lot of investors have just gone the growth part and gone, hey, you know what? International equities, let's ignore income because I need this growth. And it's the options haven't been abundant out there for investors to have a broad global diversified ETF that focuses on global income that has performed well. Because the issue is, and I did some analysis on an index, not the fund I'm going to mention, but a different fund that's been around for the past 10 or so years, and that fund's provided higher income but underperformed the MSCI World by about 122%. Over the past 10 years.
Oh, wow.
And why is that? It's doing what it says on the label. It's picking, good income companies from around the world, but you've got underweight to the US, underweight to technology, and you're in these lower growth sectors. So it's just hard to balance that way up for an investor. So the ETF we have now is the Betashares S&P High Dividend Aristocrats ETF.
Another mouthful, but a good ETF.
I know. I need to get back in on the naming conventions.
But I actually think the names of the Betashares ETFs actually make the most sense.
It is logical. And I'll run through the name. But the ticker codes, INCM, sorry, you just said
income.
it. So some investors might be familiar. Some might be familiar with the S&P Dividend Aristocrats brand. It's a brand of indices that S&P run. And so we've partnered with them. And at the core of the S&P Dividend Aristocrats methodology is the selection of companies is based on companies that have either maintained or grown their dividends for 10 consecutive years for the global basket. So these companies have, grown or maintained their cash dividends for 10 or so years. And that says a few things about a company. It says, management has an onus on, even through potentially tougher times, making sure they provide that particular type of shareholder return. It means they probably have some form of, recurring earnings and balance sheet strength to be able to do so. So that's at the core of the ETF. Then what we've done is we've taken that methodology and to try and address this shortcoming of, income strategies underperforming, we then take Global Dividend Aristocrats and we just match the sector and geographical weights of the overall portfolio to a broader global index.
Right. So you're basically saying we've got this list of companies, but we want it to look like the main one.
Exactly
that everyone
right.
knows. Yeah. Okay.
Exactly right. So you're not going to have that huge underweight to the US. You're not going to have that huge underweight to technology. You're just going to pick the high, these companies that consistently pay dividends within them. And what you'll find is actually, like looking under the hood, like there are some great growth companies that meet this mantra. Like Apple and Microsoft both make the portfolio because each of them have grown their dividends for the past 10 consecutive years. So you get these, companies that have that, I guess, that emphasis or that ownership on providing dividends as shareholder returns alongside your typical dividend stalwarts. Companies like Coca-Cola who have increased their dividends for 82 years consecutively.
Really? I didn't know that.
Yeah, exactly. Yeah, it's crazy. So you get these classic stalwarts alongside some other great names. It's a really great blend. And so this ETF, whilst it hasn't kept up with the global market, very few have over the past 5 or so years, it's done significantly better growth-wise than the traditional income ETFs, and it pays you about 1.8 times what the global market would typically pay you in terms of income. So, a really good option for those investors who, want income from every part of their portfolio, but have had to ignore international equities. Check out INCM; could be a really good option going forward. Yeah,
Dividend Aristocrats. It's a good name. I like people will be familiar with it if they've been in investing for long enough. Cool. I like it, mate. So that's 3. Do you have anything that's like not sharesy, or do you have anything that's like, I don't know, going back to what we were talking about earlier?
Yeah, I mean, we talked about one earlier, which is the global royalties.
Oh yeah, royalties.
ETF.
Yeah. Cool.
We kind of touched on that one. That is shared still, though. To be fair.
Yeah, is that ROYL?
ROYL is the ticker code on that one.
That down.
Yeah. We talked about some of those great businesses, and they get really great cash flows. And what we've done in the ETF now, the ETF isn't holding the direct royalties, right? It's holding these great royalty companies.
The companies that have the royalties.
Yeah, and all those companies will reinvest their royalty income into different royalties, diversify.
Yep.
But to make that ETF income focus, what we're doing now is we're going to be paying monthly distributions. And the distribution that we pay will match the underlying cash flow yield of the companies. So it tries to replicate this real royalty experience.
Oh, as if the royalties were going through those companies to the end ETF investors.
Exactly right, yeah. So monthly smooth distributions around, I think 5% that'll be. So, and that one too.
Is that already in place?
That has just started like two or so months ago. So you'll see if you're on the fund page, obviously all the distributions there, you'll see the most recent ones are nice and smooth as we work towards that target. So that's a really good option, and that's had really good uncorrelated returns to global equity markets while performing really well. So that's one we touched on earlier, but something beyond shares. We've touched on term deposits, offset accounts, bank deposit accounts on this episode. Something we brought out, which is a really great evolution, I think, of ETFs, is our 30BB ETF.
30BB.
Which is our fixed term corporate or investment grade corporate bond ETF. And so, I mean, taking a step back from that firstly, I mean, and this comes back to the availability of what's out there, right? That wasn't there before. If we think, 10 or so years ago, the average Australian investor couldn't really get access to an investment grade corporate bond in a very scalable manner, right? Fast forward, past 7 or so years ago, bond ETFs were coming to the Australian market, so investors could get access to corporate bonds, to government bonds. With those traditional bond ETFs, it holds a bond portfolio, and the ETF lives in perpetuity. So it's not the exact same as a traditional bond experience, right? Traditional bond, you buy, you pay the initial par amount,
$100 or whatever,
set coupons along the way, get your $100 back, right? With these ETFs, you'd buy it whatever the NAV was, you'd get income that would change over time with the underlying bonds, and then you could sell when you wanted for wherever the NAV's got, and the price will be changing around with interest rates. These new ETFs we've launched, and 30BB is the 2030 vintage of the ETF, if you will. This aims to replicate just holding, the experience of holding an individual corporate bond. The actual ETF does still hold a diversified basket of investment grade corporate bonds, Australian investment grade corporate bonds, maturing, around 2030.
Yep.
But as an investor, you buy in, you still buy on markets, you still buy at a NAV that will change, right? It still will change. But once you've bought in, that's your buy-in price. You'll get smooth distributions along the way. And in 2030, you'll receive back the par of the original of the ETF, not of the unit price when you bought, but of the ETF. So it really replicates this investment grade corporate bond experience within an ETF, which is quite a unique evolution. Because
for people that don't understand, when you go into the bond market, you typically can't go into the bond market, it's probably the first thing, unless you're a big investor. So by having an ETF, you can break it up and everyone contributes to basically the fund, which then holds the end ETF, the end bond. That makes a lot of sense too, as rates have come down, and they're going to bounce around the place. That's probably a real key uncertainty of people when they come up against bond ETFs, because it's so confusing to get your head around bonds to begin with. But then to get your head around a bond ETF that has different types of bonds inside it, different maturities, and different incomes, and it's just like mind blown.
It is definitely an added layer with the traditional bond ETFs, which they're great. They're great success. But you're right, for the average investor, it can be a bit too much. This is a great entry tool. To there's a bit of jargon in my last answer, but to simplify it, so this bond ETF will mature, if you will, in 2030, so in 5 years' time. And I checked just before I came on, you could buy in today, and your yield or the income you could expect from now until that maturity is about 4.1% per annum. So you can essentially lock in 4.17% per annum for the next 5 years, which if you think about where interest rates are going, term deposits, offset accounts, is pretty appealing to a lot of investors. Now, I'll of course caveat, investing in an investment grade corporate bond is different to investing in a bank account.
For sure, 100%.
There's added credit risk there. Investment grade corporate bonds in Australia have typically been fairly safe. We've only had 3 defaults in the history of the market.
Is it all?
3. And when I say Australian investment grade corporate bonds, it's Australian issued, so it can be global companies issuing in Australia. So one of those was Lehman Brothers had a bond here, which went kaput.
Of course,
So there is added risk, but still that investment grade space has been relatively safe for a long time.
Yeah, cool. Well, you can go to the website and find out more about 30BB. We did an episode with Cameron on this actually, while he's called in the big guns. He's called in you to come and explain 30BB, and you've done a great job, mate.
I hope so.
Yeah, but we did do an episode where we dived into the different vintages, what that kind of means, and it's an interesting thing to think that an ETF matures, like it has an end date in mind.
It's really interesting, right? I think we're working towards, because some investors we'll launch a new vintage each year, right? Is the idea. 2031 we'll launch 2032, and then potentially the option to roll that vintage into a new vintage for investors. So it is a new experience for the Australian investor.
Yeah.
One final shout out I'll say is the team's worked very hard, and if you go to the website now for this, 30BB is the ticker code, just type that in Betashares to Google. There's a calculator on there halfway down the page now.
Oh, cool.
So you can either type in, okay, how much do I want to receive monthly, or how much is my initial investment amount? And it'll tell you vice versa what it is, or tell you how much you can expect to receive back at the end. So it's meant to give really defined outcomes from a fixed income ETFs, which, as we talked about, hasn't been available until these ETFs.
That's really cool. I like it. Didn't know the calculator was on there. I'll link to that in the show notes as well. Okay, mate. So all of these ETFs will be available for people. A lot of people are familiar with the names, but this is one thing that people maybe, there's a subtlety in here, which is that when we talk about some of these topics, a lot of these ETFs are income focused. They're often in the defensive side of portfolios, not the shares ones necessarily, but definitely on the other side. And people are often thinking that ETFs are always set and forget, which I hopefully by now people that listen to the show know that's not always the case. And particularly on that side of things where you do have to be a bit more, how do I put this? You do have to be a bit more active in the way you think about that side of your portfolio. And due to the nature of them paying more income than growth, there's not as much tax consequences. And then if you have a zero cost brokerage account or whatever, you can change a bit more freely, and there's not as much of a penalty for investors to go and find those sources of income. So just as a quick mention there. But one thing that I want to just wrap up with is just to kind of put a bow on this. We've mentioned a lot of ETFs. Down to did you say, what was the GHHF?
Yes,
I'm going to put a link to that.
Geared, yeah.
Yeah, that was a Tom special. So of all the ETFs that we've mentioned today, if someone's looking to pick one to research first, which ETF would you pick and why?
Yeah, it's hard. It's hard picking between your babies.
Yeah, your favorites.
I've done a lot of work on quite a few of these ETFs from our strategy side. I'll have to say I'll go with INTM, the Dividend Aristocrats one. Why? Australian investors, we still invest majority of our money, at least in the equity part of our portfolio, in international equities.
Yeah.
Right? I think we've got a huge home bias. I think the latest data said the home bias was like 46%.
Oh, so that's why people invest in Australian shares?
Typically, yeah, still. I think a lot of investors probably who are more self-directed, that's probably lower, I would imagine.
Yeah.
There's obviously the great benefits from Australian shares, and we haven't even touched on franking credits this episode, but there's a lot of great benefits there. But my point being, even if it is 46%, we still invest the majority of our portfolios in international equities. And if you are an investor who really is, has a large focus on income, maybe you're further on in your journey, you've got that large capital base, you don't want to forego international equity growth, but you still want to eke out more income from it. I think this is a really great ETF. Allows you to do that. It allows, where the majority of your equity money sits to generate you better income. And that uplift can be more meaningful than, adding a few basis points of yield on your lower Australian equities balance, if you follow.
Yeah, definitely. So INCM is the ticker symbol. In fact, all the ticker symbols are they kind of explain what they do in the ticker symbol. If you can get like AQLTs, Australian quality, HYLDs, high yield, ROYL, Royal, 30BB, that's the vintage of the bonds, GHHF, which was a little special you brought in, which is the geared fund, the diversified one. So that's kind of cool too. So this has been a great episode talking about the ways in which you can draw income from ETFs. And as we've discussed, so many different ETFs. It's not just shares for people that are in that mindset. It's literally every asset class is available now. That at least what you want as an investor. So go and explore the range of ETFs available at betashares.com.au. And Tom, always a pleasure. So thanks for joining me.
Always. Thanks, Owen.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.